All right. Happy Friday, everyone. Really glad you're all here. I have a lot to share with you about how to raise capital. Just very brief background. Who am I? I'm Nathan. I run Foundersuite and our new platform funding stack. Foundersuite's for startups. We've had 87,000 startups on Foundersuite. And then Funding Stack's our newer platform for venture firms, emerging managers, investment bankers, startup advisors, things like that. But before launching these platforms, I spent almost 2 decades helping companies raise capital, worked at JP Morgan's private placement group, and then went off on my own here in Silicon Valley. And I've worked with hundreds of companies on raising capital. It's pretty much all I've done since college is help companies raise capital. And so this talk is basically in 45 minutes or so, everything I've learned from 2 decades of raising capital condensed into one little talk. So I would like to start off with how not to do it. So Hunter Walk is a VC here in San Francisco, and I just love this tweet. Will you intro me to investors? Is too broad a question to be acted upon. But this is how a lot of founders approach fundraising, is they just start asking everyone they know if they can connect them to investors. And that's logical, right? That makes sense. But the problem with this is it's too ambiguous. It's too unfocused. It's putting the hard work of figuring out who you should be talking to on the shoulders of the other person, where really that's your job as CEO to figure out who you should be talking to. So instead of doing it like this, we like to think of fundraising as a sales process. And if you've ever been in B2B sales, it follows a pretty straightforward framework, right? You build a list of leads or targets, you qualify those leads, you engage with them, and ultimately you're driving them all towards a close, towards a yes or no decision. And that same thing applies to raising capital. We can expand on the sales metaphor by thinking of it as a funnel, right? Top of the funnel, you're building this large potential list of investors. Then you're screening, filtering, qualifying that list. Then you're figuring out the right person to reach out to, especially if you're going after venture funds, right? You don't just pitch an entire fund. You really need to find the right person there that does your type of deal. And then where it does differ a little bit from traditional sales is about the warm introduction. So much of fundraising runs on the warm introduction. We're going to talk about how to get those intros in a little bit. But those intros lead to pitch meetings. Of course, you're going to be crushing your pitch meetings, getting through them, getting into progressively deeper meetings with more people in the room, as you go down the path. Those pitch meetings lead to term sheet discussions and due diligence. If you haven't ever been through due diligence, what does that mean? It basically is a deep dive into your business. When we raised our seed round for Foundersuite, I got a term sheet from an investor on a Friday. I was very excited. And then on Monday, they sent me their due diligence list, and it was 200 items. It was everything from articles of incorporation to personal references to customer references to financials, even access to our Google Analytics and things like that. So it's a very deep dive into your business. But you get through that, ultimately, you're selling shares of your company. So really, this is just another sales process. And I find that when we break it down into its step-by-step components, it takes away a lot of the stress and anxiety founders have. Fundraising can be learned and mastered by everyone. So hopefully we're going to do that today. First up is how to build that top of the funnel, right? I say fundraising is a numbers game. You need to be talking to a lot of investors, especially if you're at the pre-seed, seed, or even, sometimes Series A round. The numbers kind of get smaller and smaller as you go further up the rounds, but you got to talk to a lot of investors. When I raised our seed round, I pitched over 200 investors and ended up getting checks from one seed VC fund and 10 angels. And so you can do that math. I basically raised capital from 11 entities, one fund and 10 people, out of 200 pitches. That's about a 5% conversion rate between who I pitched and who wrote me a check. That also means, you can do that math, I got rejected 95% of the time. Now, keep in mind, I kind of like to think I'm something of a fundraising expert because I've been doing that, my whole career. And I'm still getting rejected 95% of the time. That's normal. We see data like that on our platform where 5 to 6 conversion rate is pretty typical. That also emphasizes why you need a really healthy top of the funnel. I'd say 200 names is minimum, but many founders should really be looking at 300, 400. Now, that doesn't mean you go the spray and pray approach, right? You don't want to go reach out to 3,000 investors. You haven't done the research and qualified them if you're doing that. So aim for, call it 300, 400 names. How do we do that? Well, obviously, there are multiple ways to find investors. I'll do a quick little demo of how to use our database for this purpose. In our database, I think most everyone on this call is a Foundersuite user. I know a few people came in off the web, but most people on this call are already using our platform. And I'll show you just a couple tips for using our database. We have 227,000 investors in here, and we have them tagged by type of investor: angel, family office, venture capital. We have them tagged by industry. We have them tagged by location, both country and in some cases city. So I'll show you that in a sec. And by stage. What I usually recommend is coming in and start typing the first couple letters of your industry. So if you're doing something in healthcare, type HEAL and you'll see the options here. Healthcare IT is going to be different than health and wellness, right? So let's say you're doing something health and wellness. Now, if I add another tag from in the same category, meaning same industry, let's say I go digital health, that's going to expand the results. So that went from 4,000 to 6,000. But now if I apply a tag from a different category, this is going to narrow down the results. So, and if I added a location and stage, that would narrow it down even further. And sometimes it narrows it down a little too much. So I often just say start with industry and maybe type. So then what do? I go through and I look at the results. And if anyone catches my eye, let's look at coastal, let's look at correlation ventures. So let me look at correlation. I double click it, open it up. Here's where I can see a little bit more detail about that, their description. You might look at their sweet spot, stage focus, kind of verify that. Maybe look at some of the companies they've invested in. And then, if they look good, what I recommend doing next is actually opening up their web page. This should open that page. And do two things here. One, go to their companies tab and make sure, I've never been on this page, kind of a weird page. Make sure they don't have a competitor. If they have a competitor, just move on to the next one, skip these guys. So make sure they don't have a competitor. And then second, look at the team. So, all right. So a lot of times, these guys have multiple partners, as you can see here. They also have a lot of data engineers. You want to be finding, ideally, the partner that does your type of deal. I don't know how correlation VC is structured, but in many cases, the partners will specialize by industry. So, for example, Trevor might be doing healthcare, David does fintech, Anu does e-commerce or something like that. So you want to be finding the right person. And once you've identified the right person, maybe the right two people, I don't, recommend going beyond that. Then you simply add them to CRM. And let's say it was Anu that does our type of deal. I just want to add Anu, and that is going to drop that investor correlation VC to the top of my research column. There they are right here. And that's how to use the database. So that's Foundersuite, but we're not the only game in town. Actually, one before I move on, the other thing I recommend doing, so, spend some time looking through the health and wellness, digital health investors here. And then once you've done that, maybe clear that out and do a keyword search. So keyword search is going to not look at the tags, but it's going to be looking in both the description as well as the companies they've invested in. So sometimes you can find a few more investors by just doing a keyword search. All right, that's how to use our database. It should be pretty straightforward. And we're coming up with some pretty cool stuff. We're going to be adding more AI to the database to help you really find the right investors faster. And we're adding a lot more investors to the database as well. We're constantly adding and building it out. So, all right, that's how to use Foundersuite. But there are multiple places to find investors. Crunchbase, everyone knows about Crunchbase, right? Crunchbase has been around forever. You can go in and you can search in Crunchbase, but the way I like to use Crunchbase is a little bit different. I will make a list of like 10 companies that are similar to mine, but not directly competitive. And I will plug each company in one by one and see who funded them. So if I was raising, let's say, a Series A round, Carta, which used to be eShares, Carta's kind of in the same sandbox as us. We overlap a little bit, but we're not really directly competitive. They do cap table management primarily. We do, all the other stuff for raising capital. So we're in the same sandbox, not directly competitive. If I was raising a Series A round, I might add Canine Ventures, Expansion VC, to my pipeline. The other way to use, and I just repeat that process with every other company that's similar but not directly competitive, I go look up who invested in them. The other way I use Crunchbase is if I get an investor. We landed FFVC out of New York, so I could plug in our venture firm, and it would show who they co-invest with, which is kind of a nice thing. But there are so many places to find investors. Man, when I started raising capital for companies, a long time ago, it was so hard. This is going to date me, but I worked at a big firm, and I would go down to the research library in this firm and check out like the CD of Pratt's venture capital directory and like go query the CD-ROM of that. It's so much easier than it used to be to find investors. This first bullet here, P Hub, Inside Venture, Venture Pulse, Strictly VC. These are newsletters you can subscribe to. I like Strictly VC. I read that pretty much every night. And basically, when a company raises a new round, they'll announce it in these newsletters so you can see who's getting funded and who's funding them, because they'll also talk about their investors. Also, when a new venture fund is formed or when a venture fund raises a new fund, they'll announce it in here. So that's a good signal, because if you're going after venture funds, the best venture fund to be pitching is one that just raised a new fund. If you're not familiar how this world works, a venture fund will go raise a $50 million fund. They'll invest half of it in a bunch of new deals, and then they'll save half of it to double down on their winners, right? So the best venture fund, again, to be pitching is one that just raised a new fund. Conferences can be an interesting place to find investors. So especially if you're in like a niche space in blockchain or cannabis or something else, go find, a couple of the bigger conferences in your market, even go back a couple of years, 2 or 3 years, and just look at the agenda, look who the speakers were. Investors will often speak at these things to build their own brand, right? So it's a high probability fit. If they're at a cannabis conference, they're, good fit for you. Quora, TechCrunch, Medium, Twitter, you guys are all familiar with all this stuff, but a couple little hacks here. When you find an investor that you like in Foundersuite or Crunchbase or wherever, go follow them on Twitter. Twitter will then recommend other similar investors, so sometimes you can pick up other leads. Also, go look up on Medium and or Substack and see if they have a blog. And if they do, follow them. And what's kind of cool about Medium in particular is I get a daily digest of Medium articles, and it will recommend new authors based on who I've followed and liked. And so if I'm following a bunch of fintech VCs, it's going to recommend other fintech VCs. So it's kind of a nice way to just get automated, potential investor leads into my inbox every day. And then, of course, Quora TechCrunch, you guys know this stuff. PitchBook, CB Insights, there's Signal by NFX, there's AngelList, of course, there's dozens of other databases out there. PitchBook and CB Insights are very good. If you can get access to these through a friend or something, I would recommend you do that, because they have really deep data, but they're very expensive. PitchBook's about $30,000 per user per year. I don't know how much CB Insights is, but I think that much or more. And then I'm going to show you 2 ways to mine your own personal network to identify more investors. So let's start with LinkedIn. Close that out. Okay, so here I am on my LinkedIn page. Okay, so I do have a paid plan on LinkedIn, but you don't have to have a paid plan on LinkedIn. Let's say I was raising a seed round. I would come up here and do a search on angel investor, and then click people. Okay, so there's 109,000 people. This maybe is the entire LinkedIn universe. I don't know. 109,000 people under the search for angel investor. That's obviously way too many to do anything with. So I want to apply some filters. So I might do a first degree connection just to remind myself of who I'm directly connected to. But the hack here is to do second degree connection. And then let's add I'll just do Bay Area as well. And I'll just start with that. So secondary connection and my location. Let's take a look at these results now. Okay, still quite a few, 3,200, but that's much more manageable than 109,000. That means there are 3,200 people that are in the San Francisco Bay Area that call themselves an angel investor that I have at least one mutual connection to. So theoretically, I should be able to get in touch with any of these people because I have a mutual contact. But it does not mean that all these people are relevant for my type of business. I consider Foundersuite and FundingStack, it's kind of at the intersection of SaaS, FinTech, SMB, right? SaaS, FinTech, SMB. So what I'm doing next is I'm going to open up a bunch of profiles and I'm looking for clues. Do these investors invest in my type of deal or do they not invest in my type of deal? So I can command click if you're on a Mac or right click, and I can just open up, 20 at a time. Katrina, she's biotech. I might even skip her, but yeah, let's skip her and go to Nikita. And, that's probably enough for now. I'll go one more, Sheil. Okay, so I've opened up 4 tabs and, like I said, I might open up 20 at a time and I'm looking for clues. What does John Saft do? And I'm typically skimming this in 30 seconds or less, both the about and then the experience. Okay, so the about, ex-investment banker. Well, that actually kind of relevant for me because we make software for raising capital. He's going to understand what we do. Now, but currently investing in blockchain and crypto. So that's kind of a negative clue, right? I might still add him because he would get what we do. I would probably also, okay, he did invest in Carta. Remember if Carta was eShares, I just showed you that. So I would probably add this guy to my CRM. And so what I want to do here is I'm going to add John Saft to my CRM and then do one more thing. I'm going to click on this link here. And I'm going to find my best mutual connection. Who knows me well enough that I'd be comfortable asking for that intro? So let's just say it's Mark Schwartzberg, right? So again, I'm going to be adding Jay Saft, I think that was his name, to my CRM. And then in the connector field, I'm going to add Mark Schwartzberg, or maybe even Jay Jung and Mark Schwartzberg in the connector fields. So I will be reminded to ask those guys for the intro when it's time. And then Command W, I close that, move on. Move on to the next guy, Luciano Chang, great name. Again, oftentimes this is in their description of what they invest in. Track record of both raising capital and investing. So that's kind of a good clue too. He's got experience raising capital. He would probably get what we do. And let's see, what else does he say here? He likes startups that leverage software and data. So, hey, we've got an investor database and we make software. So I like this guy. I'm going to repeat that same process. Add Luciano to my database and then figure out Ryan's my neighbor. Maybe I'll add him as the connector, right? Command W. How much time did that take? Maybe 15, 20 seconds, right? Same process with Nikita. And you get the pattern here. I'm looking for clues. Does Nikita invest in my type of deal or not? That's pretty much how to do LinkedIn. I like his background. I'm going to show you one other way to build your own personal network using Foundersuite. Okay, so let me go to my CRM. This is my pipeline. This is a demo account. So this isn't a real account, but you get the point. This is my pipeline of investors. But the hack here is this special column called Steve B Leads. So what I did is I come all the way over to the right. I added a column. I can drag it over there. I called it Steve B Leads. And then I go up into settings, which is under here. And I invite Steve into my account. And I have a little note saying, hey, Steve, I'm raising around, I'm building out my investor pipeline. I've made you a column in my CRM. Would you be so kind as to populate that column with some investor names that you'd be willing to connect me with? And he did. And he added like 10 or 12 names to my pipeline. I repeated this process. And backing up for a second, who is Steve B? Steve B is one of my advisors. He's a mentor of mine. He actually ended up writing a little angel check into the business as well. But he started off just as one of my advisors and mentors. I repeated this process with 5 or 6 other mentors, advisors, and generated like 50 or 60 good, strong, warm intros by having a structured way of asking them to open up their network, open up their Rolodex versus that, opening slide I showed you. I didn't just call up Steve. Hey, Steve, anyone I should talk to? This is much more actionable for him. So who else should you invite into your account? Mentors, advisors. If you have raised a little bit of money for some angels, get them involved, helping out, building your pipeline. Anyone, basically, the short answer is anyone who has potential connections to investors and that wants to see you succeed, get them involved, helping out, building out your CRM, building out your pipeline. All right, so that's how to do that. And then as Yoda says here, once you start this process and you start looking for investors, you'll start to kind of find them all over the place. So just dig into it. So once we've built this list, let's say we built a list of 400 investors. Now our next step is we actually want to start removing people off this list. Anyone who's invested in a competitor, just cross them off, don't talk to them. If they're ethical, they won't want to talk to you. If they're unethical, they will send your pitch deck to your competitor. I've seen that happen dozens of times. Number two here, if you're talking to venture funds and they have not raised a new fund in the last 2 or 3 years, they're probably only doing follow-on deals to their existing portfolio companies, right? We talked about that. Now, it doesn't mean you totally should not meet with them, but it's easy to waste a lot of time talking to venture funds that don't have dry powder or fresh capital to put to work. They'll still take meetings. They just want to invest. Now, so should you cross them off your list? Maybe. Or another strategy is to put those firms kind of top of the list and use them as pitch practice, to be honest. And kind of on that same vein, I wouldn't, if you really want to raise capital from Coastal Ventures, don't make them your first pitch, make them your 10th pitch so that you've really got your groove on by the time you reach out to them. Put your very top of the list, stagger them back a little bit. Anyway, moving on. No recent deals. This applies to angel investors, right? You're doing that work. You're looking at their LinkedIn. Maybe you're clicking through to an angel list page and you see all their deals are 5 years ago. They're probably taking a break. Wrong sector, wrong stage, wrong geographic location. This should be intuitive and obvious to you guys. If you're a fintech startup, you should not be pitching healthcare investors and vice versa. We still see people kind of spraying and praying and spamming sometimes through our system, and that won't work, guys. Please don't do that. You really want to identify the right fit people who are looking for your type of deal, your industry, your stage, your location. It'll make everything go better. Stage sometimes gets confusing, right? Because you might find an investor that calls himself a growth investor. Well, you want to grow. Growth investor actually means like later stage, B round, C round, etc. And then wrong geographic location. This is kind of an interesting topic. Jody, if we could save questions to the end, if you don't mind, but I promise I will tackle it. The location is interesting because it used to be where investors would only invest kind of in a bicycle ride around from their office or a Tesla charge around from their office. That's changed a lot in the last couple of years. Investors are now much more open to investing all over the world, which is really cool because, like we did that little game at the beginning where I asked everyone where they're located. Everyone's spread out everywhere, right? So investors started to get more open to looking at deals when like Skype and some other and Spotify and came out of Estonia and Sweden and all these places that really didn't create too many startups before. But of course, COVID changed all that. When everything shifted to pitching over Zoom and investors moved to their Tahoe place, right? Investors are really open to looking at deals, from anywhere now. It still helps to have a Delaware C Corp if you're looking for capital from US investors. That's another topic. Last but not least, bad reputation. You are going to be in bed with these investors for years, 6 to 8 years probably or more. And it's very hard to get rid of them if things go sour. I've only seen one startup that I can think of buy out their investors, and it was a very painful and expensive process. So, you're going to be embedded with these investors for years, so choose wisely. And then last but not least, think about removing about 25 to 30% of your total target list so that what remains. So in other words, you start with 400, kind of whittle it down to the top 300 or so, so that what remains at the bottom are really highly qualified, highly targeted, highly focused investors. It will make your job. This is one thing that I pound the table on constantly in founders, and people don't do it good enough in many cases. It will make your job so much easier when raising capital if you are reaching out to and connecting with people who are looking for your type of deal. Trust me on this. The more time you spend qualifying your investors, the better. It'll just make your fundraising go easier. See, Jody, I'm just going to X you out for now, but let's come back to you in a bit. Okay. Now let's recap our steps. We built this list of 400. We qualified them. Going back to that qualification, one last comment on this. Back to like fundraising as a sales process. The best salespeople, the people that make the most money in sales, don't chase every prospect. They qualify their leads. They prioritize them. They rank them. You want to do that too. It'll make your funding go better. All right, we built this list of 400. We whittled it down to the top 300. Now we want to find our best connection paths to everyone on this list. LinkedIn is, going to be your workhorse here. Plug them into LinkedIn, see if you have any mutual connections, and then, like I showed you, pick the best person and add them to the connector field in their CRM. If you don't have any connections, mutual connections to the investor, what do? My funding hack here is to look up Tim, look at what he's invested in the last 6 to 12 months, find two or three, companies that sound interesting, and cold email those founders of those startups and reach out to them very casually, like, hey, I see Tim put some money into you guys. I've been following him for years. I really like his thesis on Bitcoin, et cetera. Can I buy you lunch and just pick your brain about what it's like working with him? I'm about to start my own round, my raise. Can I buy you lunch, or can we hop on a Zoom for 20 minutes and can I just talk to you about Tim? And then you get on a Zoom or take them to lunch and you build a little rapport with that founder. It's very okay to ask them for that intro to Tim if they like what you're doing and you have a rapport. And the reason this works so well is Tim spent, probably 6 months, 3 to 4 months going through due diligence with that founder, building up trust with that founder. So there's a strong trust bond there. And on the flip side, that founder was hustling for intros, just like you're doing 6 months ago, right? And so founders are good about paying it forward, paying it back to other founders. So it's a really good way to get that intro if you don't have any connections. If you're not willing to take that time, that's the downside. It takes time to do that. If you're not willing to put in that legwork and hustle, there's always the cold email. And we even recently launched a Chat GPT integration to our email tool to help you write those cold emails. And it's pretty cool, I must say. However, even though we're building products to help with the cold email, I don't recommend doing too much cold email. The reason is Tim and other investors are getting 50 to 100 warm intros a day. So your cold email's already got a little bit of a black mark on it. But if you're going to do cold email, make sure it's extremely personalized around why you want to talk to Tim, why you think he's a good fit for what you're doing, and what you're doing fits his thesis. Now, having said all that, cold email is just not super effective. I was on a conference with Jeff Clavier of Uncorked Ventures. They're a very active seed fund. And a question came up. Someone asked, have you ever done a deal that came in over cold email? And Jeff was like, yes, we've done 2. We've invested in 2 startups that came in over cold email out of our portfolio of 760 companies. So you can do that math. While it's not impossible, your odds of having success with cold email are pretty low. So having said that, I've done cold email. I still do it if I can't find any good connections. And I do recommend checking out that ChatGPT integration to help you write those personalized emails. Okay, now it's time to really get organized. We've got, say, 300 investors. We've mapped our connection paths. This is where I used to build these spreadsheets for my clients when I was consulting the startups. And the spreadsheet works okay for about the first 2 weeks, and then it gets too messy and too convoluted. And that, of course, is basically the reason why we built the CRM. I think most of you are probably already pretty familiar with the CRM, but you're basically, as you're making progress with these investors, you're moving them through the stages of your pipeline. That little bar indicates that there was some recent activity with that investor. If I open up a card, this is where I am adding, notes, contexts, activities. If I've got an activity, for example, I've got to do something with this investor. Like, let's say I'm in some diligence with them, and I've got to send them my references by next Tuesday. I can give myself a deadline, and then I push it out to my calendar. So I actually create a little alert on my calendar that this activity is due. That's a nice little thing. And then email. If you connect your email, which is under settings, you can connect your email, and there's also a toggle called turn on team view or something. It will pull in the email conversations you're having with every investor. And if you turn on that toggle, I think it's called high visibility fundraising. Anyway, if you turn on that toggle, and let's say it's you and your co-founder and maybe an advisor all working with you in this account, you can see everyone's emails to every investor. So even if you weren't at a meeting or you weren't part of an email chain, you can see all those email conversations. A lot of people really, really like that. And of course, this is where you're attaching files. Here's all your history without investors, stuff like that. So just a good way to stay organized when you're fundraising, because you're going to be talking to 200 or 300 investors. And every time you talk to an investor, there's often a 1 or 2 or 3 action items that have to happen afterwards. So do the math, right? You're talking to 300 investors, and there's 2 or 3 action items per. There's literally going to be thousands of tasks that you have to stay on top of. This is why the spreadsheet doesn't work very well, and why I really like having a CRM to manage this. Even if you use something other than Foundersuite, get a CRM in place because you never want to be the bottleneck in fundraising. There's a direct correlation between how fast your round is going, the tempo of your fundraise, and the likelihood you are to get a check. So you want things moving fast. You've got to be executing fast. And that's why our CRM can be so very helpful in this process. And we just launched this. I forgot about this. Our dashboard. If you want to see kind of everything going on, this is a bad example because it's a demo account and I haven't sent out any emails lately. But if you want to see everything, all the activity going on in your account, that's with this dashboard. And that's only a couple weeks old. All right, so you need a CRM. You never want to be the bottleneck. Get it in place. Use it daily. Live, breathe it. We have people say, I spend 12 hours a day in my CRM because it's all I do. And that's a good thing. That means you're really taking your fundraise serious. Okay, before we get out there and start pitching all these investors, make sure your pitch deck is awesome, amazing. I get asked frequently, like, what are the top 5 reasons why startups fail at raising capital? And probably the number one answer is their pitch is bad. Too much information. It does not tell a story. Too cluttered. On and on and on. But make sure your pitch is awesome. Make sure you've given your pitch 10 times to other people who will give you honest feedback about it. Other founders, your lawyer, your attorney, that's the same as a lawyer, your accountant, anyone who will give you honest feedback. And then also, like I said earlier, don't pitch your dream investor your first pitch. Go have a bunch of practice pitches with kind of your 3rd tier investors so that when you get to your dream investors, you are really polished. I also recommend having a financial model, right? If you're raising $2 million, show how you're going to spend that money, where it gets you as a business, and ideally what your business model looks like, right? Also, it's nice to have a little 1-page executive summary. It's pretty much all you need. We used to write business plans for people. We don't do that anymore. So, all right, let's move on. I want to be mindful of time. So, all right, let's recap our steps. We built a list of 400, narrowed it down to the top 300, mapped our connection paths, figured out how to get connections or intros to basically everyone, got our pitch decks, and now we're almost ready to really get out there. When I was doing step 3 of mapping my connection paths, you probably are going to find that you have some power connectors. Jeff Thomas is a real person. He works at NASDAQ. He knows like everyone. And when I was doing this research, I noticed he was connected to like a dozen people I wanted to get, in touch with. And so I put together a little email to Jeff. Hey, Jeff, I'm raising my round. I see you're connected to these people. Do you know them well enough to make a lightweight intro for me? And Jeff can just skim this list. Hey, Nate, I know Tom, I know Sean, I know Jessica, I don't know Wesley. Clark's not doing any new deals. so on and so forth. He can just kind of go yes, no, yes, no. For everyone he says yes, this is an important slide. So if you're tuned out, tune back in for a sec. For everyone, Jeff says, yes, I'm happy to make an intro. I put together a new clean email thread. And what this is the intro request email. So notice first off how short this is. A lot of times founders, another mistake I see founders make is their intro request email will have 6 paragraphs describing the company's entire history and a 45 megabyte PowerPoint attached. Fail. No one's going to look at that. No one's going to take action. No one's going to want to meet with you. It has to be short. Investors have very short attention spans. So look how short this is. Subject line. Jeff, can you introduce me to Clint Korber? Clint's the target investor in this case. Then what are we doing? Foundersuite seed round. We had a lead investor. We had 2/3 of the round committed. Of course, we didn't start off with that. So whatever's the single most exciting, sexy data point about your business, it could be a growth metric, a revenue metric, a partnership deal, or other investors, committed, put that in the subject line because these guys and gals are getting 50 of these a day. All right, then look at the body. Jeff, good chatting with you. As mentioned, I'm raising our seed round. Here's what we do. We make this investor management and reporting platform. Here's a link to our site if he wants to check it out. And then the ask, could you intro me to Clint, the target investor, and then why? Because he does our type of deal. And then I noticed that this guy, Clint, went to the same very small college in Iowa that my dad went to. So I put that in there to personalize this a little bit. And then I include a link to our deck. And this deck is hosted on Foundersuite. We have a pitch deck hosting tool, which we're making some exciting changes to in the next couple of weeks. But this deck is not our full deck. This is what I call a teaser deck. It is 5 slides. Problem, solution, market, traction, team. All right, let me repeat that. Problem, solution, market, traction, team. That's all it really takes for Clint, the target investor, to get a feel of what are we doing, where are we at in terms of stage, traction, what's the market opportunity, and who are we, right? That's enough for him to kind of make a decision whether he wants to meet with me or not. So I like to include this teaser deck in here because I'd prefer that Clint looks at this and says, hey, Jeff, thanks, but they're too early for me. I'd rather him do that versus taking the time to schedule a meeting, driving down to Sand Hill Road, which is like an hour and a half for me, and having him say, oh, this is cool, but you're too early. And then I've just wasted half a day, right? So I actually use this deck to pre-qualify these investors. I can also go into my Foundersuite and see, did Clint look at the deck? How much time did he spend looking at the deck? And I can tailor. So if he does want to meet with me, I can tailor my meeting. If he, looked at it for 10 minutes, I might actually start off with, hey, I know you checked out my deck. I can walk you through that, or we can talk about, my big vision, right? If he didn't look at the deck at all, then I might start off like, hey, I've got a deck. Why don't we take you through that, right? You can kind of tailor the meeting based on whether they looked at it. And then Jeff, remember Jeff is my connector, can just hit, hey, Clint, forward. Hey, Clint, Nate's a buddy of mine. Can I connect you guys? Send. Hey, Jessica, Nate's a buddy of mine. Can I connect you guys? Send, right? I'm making it easy for my connectors to do their job. Very, very important. Okay, moving on. Someday I'm going to remove this slide, but today's not that day. If you haven't watched HBO's Silicon Valley, log in, borrow a friend's log into HBO and go watch it. It's a couple years old now, but it is so funny and it captures so many of the little funny nuances of raising capital. The guy in the middle here, this is Richard. He's the CEO of Pied Piper, and he's an engineer. He's an introvert. He really just wants to be writing compression algorithms for his business, but he's got to get out there and talk to all these investors. And these investors are all very smart. 40% of all VCs went to Harvard or Stanford. That's a true statistic. Many of them have very big egos. The guy in the upper right corner, the Trace Commas Club guy, huge egos, right? And investing is what they do all day long. So they're experts at it. Whereas for Richard, this is his first time, doing this. So it can be very, very stressful, as I'm sure many of you already know. The way to counteract that stress, I like to say, kind of treat it like a game, have fun with it. You're going to learn a lot about your business. And I like to say, even if you're not naturally extroverted, channel your inner hustler, right? This is your job as CEO. If you want to be the CEO and stay CEO, you've got to be able to channel your inner hustler and get out there and hustle. So a couple hustle tips: doing the intros in parallel. This means asking for those introductions from your connectors all around the same time frame. We call that the Blitzkrieg approach. And what we're trying to do is get momentum going for your deal. If you don't remember anything else from this talk, remember this: your job as the founder is to get momentum for your deal. Investors can smell if your deal has momentum. They can also smell if it doesn't have momentum, or worse, if your deal has gotten stale. And your job, this is what I want you to remember, your job is to get momentum going for your deal. That's all it really comes down to. How do you do that? What does that mean? Every time you have a meeting with an investor, they're going to ask you something like, hey, how's the round coming together? That is their way of probing, does this deal have momentum or not? You want to be able to reply to that with something like, it's going pretty good. We just kicked off our fundraise a week ago. I've got 10 meetings this week. I've got 14 lined up for next week. We're running a pretty tight process. We're using Foundersuite, of course, and I'm aiming to close this deal out early Q or late, latter part of early Q4, we'll say. I wouldn't give an exact date because those dates can shift, but give them some kind of rough time frame. And by answering that, you're saying other people are interested. You're running a process. You're using Foundersuite, of course. So you're treating fundraising as a professional job here, and you've got a timeline. And so if they're interested, they've got to kind of march to your drumbeat, because an investor's natural inclination will be to just watch and wait. So you've got to create a bit of that FOMO to keep them moving on your timeline. And another concept related to this is you want to create calendar density, right? You want to be packing your schedules just full of meetings. And we've had a bunch of people on our podcast. This one woman that was doing a biotech, she was literally lining up like 16 Zoom calls a day with investors. This was kind of during the peak of COVID when everything was on Zoom, but she would pack in like 30 to 45-minute calls back to back, but she raised a round in like 4 weeks or something like that, maybe even shorter than that. Anyway, you want to get that momentum going, and that means packing in, condensing the time frame. All right, a couple more things here. A/B test your pitch. Bring a little tip here. Bring your co-founder with you to the first couple meetings, or even have him or her off camera during the pitch. Right, just writing down every question the investor asks, and then go back and make an appendix slide. Don't let your pitch deck get all bloated. Make an appendix slide to answer those questions. And you should be constantly improving your deck. When I was raising capital, I would go pitch a bunch of investors, come home, put my kids to bed, crack open a beer, work on my deck. And by the time we actually raised our round, I was on version number 52 of the deck, right? It just got better and better over time. And our momentum picked up. So if you're getting momentum going and your story and deck is getting better, those two things really reinforce each other. And then two of my very favorite funding hacks of all time. Number one is to do a regular update to everyone who has not told you no. I'm going to show you what this looks like. So everyone in your pipeline who has not specifically told you no, don't bother me, should be getting an update from you. And let me find, this is just a sample dummy one, but we have an investor update tool. I strongly encourage you to use it. But this is what, you can make this really fancy. You can add like banner images and stuff. But this is what a good, simple update looks like. Now, there's a little navigation bar on the side if you want to, do that. But basically, this is all it is. You have an overview. What do you do, right? Make it super simple what you do. This is going to pretty much stay the same in every update, right? This is kind of a static section. Maybe you update it a little bit. We're up to like 17 billion now. I don't remember when I wrote this, but update a little bit here. And then next section, key wins. What happened last month that is exciting? It could be revenue growth, user growth, new product launches, press. You got some favorable press coverage in TechCrunch or something like that. New partnership deals, whatever it might be. Put that in, right after in the second section. Then a little bit about your metrics, and then put in a image of your product. Even if your product is super technical or boring or whatever, put an image of your product in here every time. Then next, what are you doing next, right? New product releases, new partnership deals, talk about what you're going to be doing next month, and then put in a team shot. And, I do recommend, mixing this up. Don't have a static one, change it up every time. And that's all. Look, I'm at the end of it. This shouldn't take you more than about 15 minutes to create. And what you're doing with these investors is you're, again, talking about what you do, the progress you're making, your metrics, also what you do in terms of a visual, what you're doing next, and who you are. And you start to send this out to investors, ideally even, 6 months before raising capital. So maybe you're in the middle of raising your money right now, start it now, but also start this before raising your next round, 6 months in advance. And I have seen founders, so let's say you were raising your next round in February of 2025, for example. Start sending this out August, September, October, November, December, and then in the January update, top of the page, put in here, maybe even in bold, right? Or caps. We're going to be kicking off our Series A next month. Let me know if you want early access to our pitch materials. And the amazing thing is I've seen startups have their deals swooped up before even going out to market. It's like the real estate here in Marin. Houses sell before even going on market. I've seen that happen with founders because they've nurtured these relationships with investors in advance, right? Over a period of time. So imagine for your next round, you don't even have to go out hustling. You have a distribution list of relevant people who have been looking at your update and they want to do a deal. It's incredible. So really recommend doing this. Now, one other little thing I'll show you really quick. One of my favorite funding hacks is, I don't have this open right now. I have to connect my email, but under Compose, there is a permission email. So we have a permission email template. And that is going to be a great way to break the ice with investors. It's basically saying something like, hi, Tim, I see you've been investing in fintech and SaaS for a while. I'm not raising money right now. I run Foundersuite. We make software for raising capital. I'm not raising money right now, but I will be next February or next, Q1 of 2025. Can I have your permission to add you to my distribution list? And can I give you an early access to what we're building here? Those words, can I give you early access to what we're doing? Investors love it. And so you're not asking them for money right now. You're not asking them for time. You're just asking for permission to add them to your company update list. It's a really nice little email. So try out the permission email, especially if you're going to do a cold outreach to investors. The permission email is the perfect way to reach out to them. So, all right. Sorry, I couldn't show you that. I had to connect my email again. And then last but not least, setting up a data room. So before I move on to that, think about doing the permission email and the company update, monthly cadence company update as a way of nurturing and building relationships, right? This is marketing 101. You're just keeping them informed of what you're doing. And then last but not least, setting up a data room. So let me show you what a data room looks like. This is a data room. Now we have a product for this too, but you go in and you build these folders. And I think I only have 11 folders, right? So we've got corporate docs, pitch, financials, IP, technology architecture, market research, team and advisors. And then you start populating this with your documents. And then what can you do? You can invite investors into the entire data room if you want to do that here, or you can invite them to view only specific folders, or you can even invite them just to view specific files in that folder. So let's say I just want to invite them to get this or this deck. I go in and I invite them, and let's say let's say I'm going to build, and then I can choose what they can do. View only, or view plus print, or view plus print plus download. I can designate what they can do. No, okay, so that's how to use it, but why is the bigger question. The data room is such a beautiful thing. There's two reasons to run a data room. Remember at the beginning of this talk, I told you about how I got a term sheet from an investor, and then they sent me their due diligence list. Well, their due diligence list of 200 items, I wasn't prepared for that. And it took me about 2 or 3 months to really get all the due diligence stuff compiled. And that was way too long. The deal started to get stale. And I was like I was having panic attacks and waking up in the middle of the night, like, they're going to pull the term sheet away from me. They're going to cancel this deal because it was taking too long to get through due diligence. Now, I really thought I was getting an ulcer by this too. It was so stressful. Now, contrast that scenario with a scenario where I had prepared a data room in advance, and they sent me the term sheet on Friday, and on Monday, they send the due diligence list, and I say, "Oh, great, cool. Let me give you access to my data room. You'll find all that stuff in the data room." Boom! I have just shortened my due diligence period from 3 months to 1 week. And I look like a professional. I look like a rock star if I'm that prepared, because not that many startups do this. Okay, that's reason number one. You'll look like a rock star if you've prepared a data room in advance. Number two, why I love data rooms so much is you can use this as a catalyst. So let me go back to my pipeline. So let's say I have, just an example, there's 50 people that I've pitched but haven't put down their term sheet. I can send an email using send email tool. I can pick this column. I can send an email to everyone in the pitched column saying something like, really enjoyed our meeting recently. We're going to be opening up our data room September 2nd through September 27th. If you are pretty seriously considering putting down a term sheet, if you're pretty seriously interested in our deal, let me know, and I will give you access to our data room. So what am I doing here? I'm using the data room access as a catalyst to get people to kind of, shit or get off the pot, excuse my French, to either commit and signal their interest or to opt out. And you'll get people like, thanks, but this isn't a good fit for us. And you actually want that. You want people to kind of opt out. And then you want people to say, I am interested. I would love access to the data room, right? So you're using this as a forcing function. You're using access to the data room as a forcing function to get people to kind of make that decision. Really, really powerful stuff. So think about that. Okay, guys, I know this is a long talk. I'm going to wrap it up here. Down at the bottom here, I thought I was getting an ulcer. I really did. I asked my dad, who's a doctor for ulcer medicine, and I went to the prescription, and they're like, it's $300. I'm like, okay, I'm going to just suffer through this. I didn't get an ulcer, but I thought I was. That's how stressful fundraising is. It's also treat it like a full-time job. If you can give some of your duties to your co-founder so you can concentrate 100% on fundraising, that's how you want to do it. I'm going to skip some of this stuff. I'll send you this deck though later. I just do want to finish on this slide. So, you've been fundraising for a couple weeks here, and now it's trying to close the round. So every time you have a pitch meeting with an investor, we want to do these first two bullets. Don't finish your Zoom or your meeting without saying something like, hey, I really enjoyed talking to you today. I would love to hear what your typical check size is. This is what you say to an investor. I would love to hear what your typical check size is, what your interest level is in my deal, and what are next steps. And then stop talking. And you'll probably get a generic answer like, oh, we'll talk about it at our Monday partners meeting. But if you get a next step in that answer, that's a really strong buying signal. Number two here, actually make them chase you a little bit. So again, before you finish the meeting, say something like, I really loved telling you about my vision for Foundersuite. I would love to hear how you, Mr. Investor, help your portfolio companies and how you would help me grow Foundersuite. And then again, stop talking. Make them actually pitch why you should let them into your deal. And the reason this can be so very powerful is because every investor who's been an investor for more than 10 minutes has lost out on a competitive deal where there are more investors trying to get in than there were seats at the cap table. So you're signaling to them that they might have to actually hustle to get into your deal. And as your momentum increases, they can smell that. And I've seen deals turn into like a piranha feeding frenzy where all the investors are trying to get in. That's a good signal. That means you've done a good job. I'd love to hear about it too, because I really take pride in that. But and that also means you get all the leverage. You have all the negotiating leverage. You can set the timeline, the terms, all that stuff when you get that sort of leverage and momentum. It can take multiple pitch meetings before you get a term sheet. The hardest part is getting that first term sheet. 80% of your effort in fundraising is getting the first term sheet. Once you get that, you can use that to get the rest. And then it can be hard to get a yes or no. So we actually have a column in my CRM. I'll show it to you really quick. We have a couple columns here. I've got my no. This is the hard no, right? People who said hard no. Then I've got a no response and a revisit for Series A. So people who ghost me go in the no response. People who say, I like you, but you're too early, get moved into this. It can be hard to get a no. When someone does say yes, do the Paul Graham handshake deal protocol. This means, you just had a coffee with them. They say, I like it, put me down for 50,000. Go back and just say, it's really great meeting with you. Just to confirm you're in for $50,000. Can you write back and confirm that? And if they write back, pretty safely, you can move them into your committed column. If they don't, they're just still a prospect. Last but not least, if you're going to do this, if you're going to go raise money, don't stop until you actually have the money in the bank. My corny dad joke. How do you know an investor says yes? When their check clears, when the wire hits your bank account. Everything before that, even a verbal yes, even a term sheet is not a hard yes. The only hard yes is when the money actually is in your bank account. So, get it over the finish line, take your team out for a nice dinner or something. And then just put this all in perspective. You just raised $1 million or $2 million. That buys you, 12 months of runway. You need to start this process all over again a couple months from now. Start building that target list for your next round. Start sending the permission emails. Start sending a company update to those investors, and it'll make your next round easier and faster. Okay, let's open it for Q&A, but I wanted to just plug a couple of quick things, super quick. I'm almost done. I would love to connect to anyone. If we're not already connected, I'm linkedin.com in Nathan Beckord. Maybe just mention that you're either a Foundersuite user or attended this thing, because I get a lot of random invites. Love to connect with you guys. Also happy to just, respond to emails and stuff. The three quick plugs, I will say, we have this pretty good YouTube channel. A lot of really interesting stuff on here. Just all kinds of stuff, interviews with founders. There's like 280 interviews with founders and VCs. Also have a good blog, just blog.foundersuite.com. Lots of good stuff here. How to get funded by celebrity investors. Everyone wants that. And then the podcast is on iTunes, Spotify, called How I Raised It. So love it if you guys check it out. There's some pretty interesting stuff here. Give us a little rating or whatever. And all right, that is going to do it. Okay, I'm just going to go through these real quick. And if let me get through what people already typed, and then we can raise hands after this. Anonymous says, what is the best interval to follow up with investors who have done follow-up meetings? What is polite and doesn't turn them off, but doesn't leave too much time for the connection to go cold? This is a good question. How much, I'm paraphrasing, how aggressive should you be in the follow-up? You got to be pretty aggressive. The reality is, because these investors are just getting inundated, right? And so I like to follow up about every 3 days, and I will follow up. You didn't exactly ask this, but I will follow up to 6 or 7 times. That's a lot, right? But I know people who have finally got a response, and sometimes led to a check on follow-up number 5 or 6. So, but at the same time, if they're not, there's a quote I like, you want to get to a point where investors are chasing you. You're not just chasing and nagging them. And as you get momentum going, that sort of shifts, right? They start to chase you more and you're doing less chasing. So there's the other approach. You have to follow up a bunch of times, but if you're not getting much of a response, they're probably not that interested, right? Ghosting is probably one of the number one ways investors say no. So I'm giving you kind of mixed answers here. If you really like someone, follow up with them a lot, but know that non-response is another way of saying no. Nathan, are you specifically focusing on VCs here, or does it apply to angels too? I mean, pretty much everything I talked about today should apply to both. I know I kind of jumble up seed round and Series A rounds with some of this talk, but everything I talk about applies to both. Yep. Charles says, I'm a solo founder with an MVP, minimal traction, and huge TAM. I need 200, 300K. What co-founder would be more valuable to an investor, an industry insider or a person with 2+ startups build and launch? So I am going to lean on the person who has built startups before. And I don't know what you mean by industry insider. That maybe if it's someone super special, but investors are in the business. You've probably heard people say this. Investors are in the business of pattern matching, and they're looking for patterns. And one of the patterns they look for is what the team looks like. And many investors have a very strong preference for a team that looks like as I call it, a hacker, hustler, and ops person. Maybe it's a 3-person team. Someone who can build the product, someone who can hustle and sell it, and then someone who can kind of keep the business running. So if you have someone who can build it or has built things in the past, you need that. That's going to be attractive to investors. I would kind of lean on that. Anonymous asks, what did you mean by skip them if they have a competitor's page? Okay, good. Glad you asked that question. So let's say I find a venture fund that looks pretty interesting. They invest, I keep using us as an example, but they invest in fintech and SaaS. Cool. But I see that they invested in a direct competitor to us. You don't want to talk to them. They won't invest in you. And in worst case, they will share your pitch deck. Almost no investors. I mean, there are a couple exceptions I can think of, but pretty much no investor, if they back one company in its space, they won't touch another one. So don't waste time. It's going to hurt you versus help. David asks, can you explain about pre-seed valuations raising from abroad? That's tough. I don't have the data. I would look at what Carta is a guy named Peter Walker. Follow him on LinkedIn. He publishes a lot of stuff about both kind of trends in funding. Like he just came out with something where investors are doing a lot more capital calls recently, which means they're starting to do a lot more deals. Like he publishes some pretty interesting data. I bet he's got stuff about pre-seed valuations out there. I can't really comment on. Now, having said that, there is a bit of a discount if you're coming from abroad. So an equivalent company, let's say there's two exactly the same companies, but one's based in Palo Alto or Silicon Valley, and the other's based in Estonia. The valuation for the one in Estonia is going to be lower. It's just the way it is. Now you can help with that by setting up like a Delaware C Corp and maybe have a San Francisco WeWork address, stuff like that, kind of change that a bit, but it's going to be lower. Anonymous, your first raise, you may not have enough funds to create tons of momentum. How do you create these updates to be meaningful in that case? Yeah, that's a good question. Look, startups are hard. No one has enough resources, time, or money to do everything they want to do. The best founders find a way. I know that's sounds patronizing, but you got to do that, right? There are dozens of free ways to build momentum and traction, even if you don't have money to spend. I'll give you one very small example. When we were launching, I had no money. We bootstrapped it for the first several months. And what did we do? We put on events called Startup Funding 2.0, where we would recruit a bunch of investors to be on a panel. We would find some larger startup or law firm to host a space, and we would sell tickets for $25 and get 200 founders in a room. And of course, I'm the MC. And so I'd say, oh, thanks everyone for coming. I know you're here to listen to these speakers. By the way, we have this new Foundersuite. So we actually made money. It was marketing for our business, but we made money for it and got customers from it as well. So you got to find creative ways, to generate the stuff that you want to put into your updates. I can't tell you what that would be for your business. What should we include in a data room if we're pre-seed? I'll give you two short answers to that. One is if you set up a data room, I'll give you those folders structures, so you can kind of look at those folders, which is, your company articles, your marketing stuff, your IP, your financials. So you can put that stuff in there. That should guide you. And then there's also in our docs, there's a due diligence checklist. And so you might look at that due diligence checklist, go through that, and figure out how much of the stuff you can do there. So even if you pre-seed, you maybe not going to have a lot of historical financials and things like that. You got to do the best you can, right? Look at that list, see what you can provide. Grit, I've heard that we now should plan for funding amount to last 24 months. That's a much bigger ask and therefore tougher to sell. Yeah, and I use 12 months, which is probably on the short end. I would probably actually estimate about 18 months, splitting the difference a bit here. 12 months is a bit short because if the market's tough and that's short. 24 months is pretty long. Budget in 18 months, and what you could raise on that is kind of how I would answer that. The market's tough right now. The market's still really tough. We're seeing, I talk to our customers all the time. They're struggling. It's taking longer to raise. Valuations are still kind of tough. So it's hard. You just got to hunker down and be frugal on costs and, raise for 18 months is my answer. Nikhil, what's a good cadence for sending investor update emails? Good question. I love this. I like to default to a monthly investor update because I think that's a good cadence, right? It's not too much, not too little. One tip I love to do, which I didn't say in the talk, actually block off on your calendar a recurring meeting. Block off 2 or 3 hours on the third Friday of every month, right? And have that a recurring thing for doing that. Because the problem a lot of founders have is they'll create an update. It's great. They get a good response and then they forget to do another one. So if you block off your calendar to write your updates, that'll help. Just one last thing about that question. If you have so much velocity and exciting stuff happening, then a bi-weekly update could be okay, right? But there has to be enough meat in it to justify that. I would go for monthly typically. Sean asks, how would you rate geographical zone when it comes to investors? Well, I don't know. I mean, that's a big question that we could spend over hours talking about. Investors vary all over the world, right? European investors often want to see more traction and revenue. Silicon Valley investors are maybe more open to like big idea, big market, great team with no revenue or traction. So investors vary all over the place. I don't know if I can answer that in a short amount of time. Anonymous, what's a good target time to spend on raising the first check? Yeah, good question. Plan for probably a minimum of 3 months, more likely 5 months to raise capital in this market. If you're still raising after like 8 months, it's probably getting stale and taking too long. When we raised, and this is a while ago, it took me about 5 months to raise my first round. So if you do it in like 2 months, that's really fast. So kind of plan like 3 to 4 or 5 months to get it done, which I think goes to Keith's thing. How long from start to your raise did it take to get your first check? Yeah, it took me like 5 months. Now, I did say our due diligence process dragged out. So if I had done the data room approach, I probably could have condensed a 5-month raise into 3 months, is my guess. All right, Sean, what would be best, a single investor or multiple investors for start? I mean, typically multiple investors, right? Like I lean on, as I told you, I have a bunch of investors in our business. I just had a call with John Frankel of FFEC yesterday. He had some cool product ideas, how to add more AI into our product. And I have other investors that are more like Steve Bennett, right? He's more of a CFO type, so I can lean on him for financial questions. All right. So, I'd say the more the merrier up to a point. If you get too many investors, it might be hard to manage all them, but I go multiple. Anonymous, talk about the trade-off between bootstrapping and going slow or getting investment, diluting and going for broke. Yeah, this is a classic trade-off. Do you bootstrap and control your own destiny, or do you, go big and possibly lose it all? It's kind of, to paraphrase that, it kind of depends on your market. If you're in a space there that has a big market, AI is a perfect example, right? I mean, think of all these AI companies, big market, it's going to create some big home runs, and all your competitors are raising lots of money. I don't think you can bootstrap that, right? You're not going to create a viable competitor by bootstrapping. So it kind of depends on your market and what your competitors are doing. Having said that, even though I sell software for raising capital, I love companies that have bootstrapped their way to 5 million in revenue, and they're the boss, right? Like we've only raised a small amount. We're venture backed, but we're still kind of bootstrap. I still control the board. I still have, well over half the equity. So I love companies that have been able to do it. Paul is asking how fresh our invaded investor database. We have a 11-person data team that is constantly updating it. Now, they do it in waves. So we just updated 101,000 angel investor contact information. And we're doing it also. So we just did a kind of a type of investor. We also fairly recently added family offices, trusts, endowments, and foundations. So those are like newest. Other sectors might be a little bit older. We are moving towards a system of kind of always on identifying bad data because the database changes, right? You publish a database on a Monday, X% of it is already out of date by Friday. It's just a constantly moving target. So it's very hard, but we work on it constantly and we're moving towards a more continuously updated thing. And we're also adding to it too. Our next big project after a rewrite, which we're almost done with, is tackling the database. So you're going to see some big improvements in that. Now, having said that, you're still going to get some bounces. One thing I would strongly recommend doing is, let's say you build a list with our database. Before reaching out, export it to a spreadsheet and run your investor list through a service like Zero Bounce or zerobounce.net, or there's tons of these out there. It's very cheap and it'll identify any bounces. Anonymous, we are getting interest from some of our customers and partners. What about corporate investment versus VC or professional investors? Okay, this is a good question. Question is really, should we explore corporate VC? Corporate VC, if you're not familiar, it means a lot of large companies have a VC arm that they're investing off their balance sheet. So it's different than a traditional VC. The advantage is, sometimes these corporate VCs can help you with product, with distribution, with marketing. There's usually some perks that come along with taking a VC check from a corporate VC. Disadvantages is what we call the corporate bear hug, which is, they might put terms in there where they get like first right of refusal to acquire you, right? So they might constrain you in some other ways. They might help you in some. It really comes down to kind of the terms, frankly, and what sort of boost you could get from a corporate VC. So it's pretty case dependent. Faye asks, if a deal already went stale, but a company pivoted towards a very different strategy, how to reignite investors' interest? This is a good question. So your deal got stale. How do you reignite? Metrics, numbers, growth cures all ills, cures the staleness. It's like the air freshener. Good metrics is how to do that, right? Now, just a new strategy, it might, be enough to get another meeting with investors. But really, if you can get a new strategy, we pivoted, we're doing this, it didn't really work out. We pivoted to this and it's working out. And here's how I can prove that. Here's our metrics. That's the best time to re-engage, because it's pretty hard to re-engage with investors, right? They have their own CRM systems. And if it went stale, you're probably in there as pass or no, right? I mean, you're kind of flagged as no. And it's hard to get investors to unflag that no. But the best way to do it is just have really good metrics around that. Now, I'll tell one more little quick story. Like when we first got going, I tried to raise money. I spent a month or two raising very early on, was getting nowhere. I'm like, okay, I'm going to quit, go back, spent 6 months, building product and just getting things better. And then tried again to raise money and still wasn't getting any success. And then again, quit, and then went back for the third time. And it was kind of do or die. I'm like, I'm running out of money. I can't bootstrap this thing myself. I either have to raise money or quit this business and give up. And the third try, finally, it was a success. But so I didn't really pivot in between, but I kind of took breaks in between my 2 previous tries to raise money and had advanced it far enough on the third try. And I really did the full court press on the third try too, where I just talked to everyone I could, right? And it worked out. So, that's another answer to that question, I guess you could say. Thank you, everyone. Happy Friday. And I'd love to hear about any success stories. If you put some of these strategies to work and they work for you, if you raise money, I'd love to hear that, especially if you're a customer. It really just is really great. So I'd love to hear that. And good luck. And hopefully this is valuable to you. Over and out. Thank you.